Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting. And our topic today is operating cycle. What is it and how do we calculate it? So first of all, what is the operating cycle of a company? So if we go to a regular merchandise or manufacturing company, we first start with acquire inventory. Raw materials or finished good or whatever, but we acquire inventory. The second one, we prepare inventory for sale to customers. So this is related to inventory. If we are talking about a service company, they don't have these first two. Okay. Now we sell this inventory. So we deliver the inventory to customers. And finally, we collect cash. And then this go up again. So operating cycle is used for a lot of stuff. One of them is to check the time for current assets and current liability, because it doesn't matter if it is international accounting or US accounting. The time frame for current asset and current liability is 1 year, or the operating cycle, which one is larger. So if a company has operating cycle equal to 200 days and it's lower than 1 year, so it is 1 year. If the operating cycle is 500 days, then the current asset and current liability time period will be 500 days. Or, that is our topic today, we use it to make an analysis of the inventory and accounts receivable. How many days, so how long does it take? So how many days take the operating cycle? The larger the one, more money the company needs to pay to sustain their operation, because it takes a long time since the purchasing of inventory or raw materials and collecting money from the customers. If we are talking about a grocery store, for instance, it is very short, because they buy tomato, they need to sell it in 2 or 3 days, and they sell it, it is on cash or card. And at least here in the US, even credit card, grocery stores get the money in some days. So their operating cycle can be very short. If we are talking about a manufacturing company with long assembly line and long times to manufacture their products, it can be months, and that is what regularly happens. And then what are the formulas to find it? So the formula is inventory period plus accounts receivable period. That is inventory period number 1 and 2, accounts receivable period number 3 and 4. However, how do we calculate inventory period? We have the turnover. Why do we have the turnover? Because inventory period is 365 divided by inventory turnover. We can combine it in only one formula, 365 divided by cost of goods sold divided by average inventory, or 365 times inventory average inventory divided by cost of goods sold, and so on. So we can work with tons of different formulas. What I like the most, I break it into formulas because it's very easy to set up it wrong using Excel, because the formula is too long, too many parentheses, so it's easy to set it wrong. And the receivables turnover, credit sales divided by average accounts receivable, and accounts receivable period 365 divided by receivables turnover. We have only an issue here. Credit sale is the most accurate metric. However, if we go to public companies, they usually don't disclose their credit sales. So we go into the net sales. That is the best proxy when we don't have the credit sales. Okay, so let's go to the Excel file. And remember, the Excel file is free, and the link to download it is in our video description. So let's talk about 3M, US-based company in the state of Minnesota, where I live. So that is why I like them. These are public. numbers. I got it from their 10K and also on accounting database, for instance, Refinitiv Icon, the one that I use, or CompuStat, or or Bloomberg, or any other database. They are all very good. So I grab the balance sheet and the income statement. So let's find the operating cycle. So here we have another issue, the average inventory. So I create a cell for the average inventory. It will be easier. So average, and usually the average we collect only 2 years. So that is why I have the 2 years here. So average inventory, total inventory here. So $5,000. So the number is in millions and billions. So, but 5,000 is the number that we get. Inventory turnover, cost of goods sold, so on income statement, cost of revenue, that is the how companies usually name their cost of goods sold, divided by this average inventory. So 3.62. What does this 3.62 means? It means that the turnover, the rotation of this inventory is 3.6 times a year. So if we can want to move this from times to days, 365 divided by the inventory period. So 100 days. So almost 3 months here, or more than 3 months here, 3 months and 10 days. For the accounts receivable, the average of accounts receivable. So average accounts receivable, where are you? Accounts receivable. A trade net, that is what we usually get. $4,600. Receivable turnover, credit sales. We don't have it, so we get the net sales divided by the average. So 7 times. So it is the same for the inventory. So we collect money 7 times a year. If we want to move it to days, 365 divided by time. So 51 days. So almost 2 months here. And then the operating cycle is where we combine those numbers, 100 plus 51. So 152 days. So 30, 60, 90, 120, 150. So 5 months is their operating cycle. And then we can get tons of analysis based on these 152. Okay, and then 3M use 12 months for current assets and current liabilities because their operating cycle is lower than that. Okay, guys, that's it. Thank you so much. If you have questions or comments, just leave them here or email me. Have a very nice day and God bless you.